back and relax. You're listening to the WealthTech Today podcast. I'm your host, Craig Iskowitz, founder of Ezra Group Consulting. And this podcast features interviews, news, and analysis on the trends and best practices all around wealth management technology. And this is our November news roundup. We have a lot of stories for you. We've got private market platforms being snapped up. We got a little estate planning, a little financial planning, some integrations, and of course, the Advisor Tech Map. And speaking of the map, how many applications do you have in your tech stack? 20, 30? Probably a lot more than that. However many you have, you need a strategy for managing them, integrating them, and delivering a world-class experience for your advisors and clients. Ezra Group can help turn your tech stack chaos into a competitive advantage. Our 90-day tech stack reboot is designed specifically for RIAs looking to take the first step in gaining control over their tech infrastructure without breaking the bank to do it. If you want to free your firm for exponential growth, you need to run, not walk, to our website, EzraGroup.com, and click the golden Contact Us button on the homepage. Whether you're struggling to scale your business or wondering why your advisor adoption of your core applications is so low, the experienced team at Ezra Group will help you design, optimize, and future-proof your infrastructure. We know what works and what doesn't. All right, a couple of quick housekeeping tasks. Please subscribe to this podcast, yada, yada, yada. Check out our sponsor, the Invest in Others Charitable Foundation at investinothers.org. And if you are a software vendor in the wealth tech space, you should register your product at ezragroup.com/register and update your wealth tech integration data so your scores are always the latest. All right, let's kick this thing off. First story is really two stories. It seems like a trend here. We've got two stories on companies buying up private share platforms. First is Schwab agrees to buy private share platform Forge Global Holdings for $660 million. That's quite a sum. And Morgan Stanley acquires a private share platform called EquityZen. And they didn't say how much they're paying for that. So under the terms of the transaction, Schwab will acquire all of Forge's shares for $45 a piece. That's about 72% more than the closing price on Wednesday. So it's a public company. It's why they had to announce that. The deal will be the first for Schwab under CEO Rick Wurster, who took the helm of the retail brokerage at the beginning of this year. Acquiring Forge could aid his ambition to give customers more opportunities to gain exposure to unlisted companies, especially as those firms stay private longer. There's a lot more private companies today than there used to be, and fewer public companies. It makes sense to think about providing direct access to retail investors, said Wurster. And Morgan Stanley, they acquired EquityZen, and the acquisition enhances their distinctive private market ecosystem that provides a full suite of services to private companies and their shareholders, including cap table solutions, tender and liquidity programs, direct and co-investment opportunities, and secondary trading. So EquityZen's issuer-aligned model will support the firm's efforts to deepen relationships with private companies, and this will provide Morgan Stanley at Work, which is their subsidiary that works with private companies, to access additional liquidity options as well as increase access to private shares. The integrated offerings will have the issuer at the center of the decision-making, allowing them to have full discretion over when and how their shares trade. EquityZen serves as a powerful benefit for issuers and their employees, providing streamlined operational processing that is powered by the direct integration with cap table solutions provided by Morgan Stanley. EquityZen has been around since 2013, and they have over 800,000 registered users. That's not active users, just registered, but still a lot. And have processed almost 50,000 transactions across more than 450 private companies. And then on the Schwab side, their firm, so shares were up, the firm were up 27%. In New York trading, Forge has jumped 87%, giving them a market value of $355 million. So again, what these two firms are doing, why are they buying it? What's this private market land grab? So the Morgan Stanley at Work is their workplace wealth platform serving corporate clients with equity compensation administration, financial wellness programs, and benefit management. This business has become increasingly strategic because it creates a captive pipeline of high net worth individuals before they even realize they're wealthy. The Carta partnership with Morgan Stanley was phase one. So Carta dominates cap table management for private companies. By becoming Carta's exclusive U.S. equity management and workplace solution, Morgan Stanley positions themselves as the default provider for these companies' employees. So they're trying to build this ecosystem that funnels new wealthy people into their wealth management business. So why add equities in? At the company level, Morgan Stanley manages the cap table. They know exactly who owns what, when the shares vest, what the exercise prices are, and they control the liquidity events that occur through equities in. At the employee level, employees receive equity grants through Morgan Stanley at Work, and then when they want to liquidate, they want to buy a house, they want to diversify, they then get access through equities in. So the transaction will settle seamlessly because Morgan Stanley controls both sides. And then when they need more wealth management, they transition them to the private wealth business. Now, Morgan Stanley currently has 20 million wealth management clients that will also get curated access to pre-IPO deals. That's a great benefit for those clients. So now let's talk about data. There's a huge data play here. Compensation data for Morgan Stanley at Work tells them who is about to be wealthy. Cap table data shows them which companies are the winners, and then those employees will get wealthy. Transaction data from Equities N reveals investors' appetite and their pricing. And then the banking relationship tells them which companies are preparing for liquidity events. So Morgan Stanley can now predict wealth creation events 18 to 24 months before they happen and proactively reach out to employees who will soon need sophisticated wealth management. So that's going to preempt all these AI tools that are launching now that are doing prospecting, looking for money in motion. They're now going to be 2 years behind Morgan Stanley. So if you're using an AI tool that's monitoring LinkedIn or other news outlets or other public information, you're not going to see this. So all those AI firms are going to get locked out of all this data. Uh, Also, there's an investment banking connection. Morgan Stanley can offer employee liquidity solutions as a perk, using tender offers through Equities N, and this strengthens relationships with CFOs and their boards and positions them for eventual IPOs when that happens. There's also horizontal leverage across Morgan Stanley, the private wealth management, their investment management, their investment banking, and their lending businesses all that get connected. Now, talking about Schwab, they're similar in some respects, but they're more the democratization play. So Schwab has 35 million client accounts, significantly more than Morgan Stanley's, but not quite as high net worth. So the typical Schwab client locked out of pre-IPO investing. So the best deals go to venture capital funds, private wealth clients at Goldman and Morgan, and accredited investors. So the Forge acquisition gives Schwab the infrastructure to offer private market access at scale to their retail base. So they can do things like creating thematic portfolios, like, hey, buy this late stage tech platform, this group of companies that are late stage tech, or buy these pre-IPO healthcare, or this unicorn track portfolio. They can do structured access portfolios, ETF-like products. They can integrate with Schwab's intelligent portfolio to create alternative asset classes. And of course, fractional share technology lowers the minimum investments. Now, Schwab also has a workplace business through Schwab Stock Plan Services. While it's not as dominant as Morgan Stanley at Work, they still have many corporate clients with equity compensation administration. So they have the same capabilities. They're trying to build the same closed ecosystem, offering employees liquidity programs, competing against Morgan Stanley and other firms, and building sticky relationships before these liquidity events. Now, the key difference is Schwab probably is going to take a more open marketplace-driven approach versus Morgan Stanley's issuer-controlled model. This could appeal to employees who want maximum liquidity and companies who are comfortable with a broader, more public marketplace. Now, of course, both firms are custodians, but Schwab owns the clearing and custody infrastructure for thousands of RIAs, which is a benefit that Morgan Stanley doesn't have. So advisors, their RIA clients, can offer private market investments without leaving the Schwab platform. Custody reporting and billing stay unified, creates a massive advisor convenience and platform stickiness. Custody assets, alternative investments have historically forced assets off platform, but now they can stay on. Keeping these private investments on platform means Schwab retains the assets and can cross-sell other services like banking, and asset management and other parts. So clearly, both these firms are in the same area. They both probably have a vision of an end state where they control more of the private market. They build these closed ecosystems and continue their domination in their respective spaces. The time is critical because private market infrastructure layer is consolidating. 5 years ago, you could partner with multiple platforms. Today, winners are emerging. In 5 years, this will be an oligopoly controlled by two or three major financial institutions. Could be Morgan Stanley and Schwab. So they see this as fundamental to their business, controlling private capital markets. They won't be relegated to serving post-liquidity, slower growth, wealth management relationships. So it's not about controlling where wealth is created, right? But it is about controlling where wealth is created, not just later down the road where it's managed. You know where to find Schwab and Morgan Stanley online. All right, our next story. Wealth.com named exclusive estate planning provider for indivisible partners. Wealth.com, the leading end-to-end estate platform for financial advisors, today announced that it has been selected by Indivisible Partners as its exclusive estate planning technology provider. The fast-growing independent wealth management firm was founded by a team of industry veterans, including John Teal, former head of wealth management at Merrill, and John Hogarty, former chief operating officer of global wealth for Bank of America Merrill Lynch. Throughout this collaboration, Wealth.com will serve as Indivisible's exclusive estate planning tech provider, seamlessly integrating into the firm's modern advisor wealth platform. Advisors will be able to generate accurate, real-time plans that evolve alongside clients' financial lives, reducing administrative burdens, increasing efficiency, and supporting better client outcomes. Now, Indivisible is an interesting firm. It's structured so that the advisor teams own 100% of their businesses while also participating in the broader partnership's growth. Unlike many RIA roll-ups backed by private equity, Indivisible is not PE-backed. Teal says avoiding external investors aligns incentives differently. Less pressure for exits, monetization, which he argues helps focus on client and advisor interests. Now, the firm, when they started, they had no assets, or at least no assets listed, but they recently announced their first advisor team with $640 million in assets and another team called Ride Wealth Partners based in Colorado with approximately $4 billion in assets we're joining. So that gives them $4.6 billion in assets. So it's a fast growing firm. Now, this announcement follows Wealth.com's integration with Advizon, the all-in-one wealth platform that underpins Indivisible's technology. So there you go. With both integrations now live, Indivisible's advisors gain access to a unified environment connecting portfolio management, financial planning, and estate planning. Now, Wealth.com, you can check them out on our website, EzraGroup.com, on our WealthTech score. They have a score of 7.54, which is the highest in the estate planning category. Congratulations, Wealth.com. And Advizon has a score of 6.13, not the highest in portfolio management, but still very solid. So you can check them out at Wealth.com and Advizon.com. Next up, we have a trio of financial planning stories. First of the trio is Right Capital unveils cutting-edge OCR solution to automate financial plan transitions from the eMoney platform to Right Capital. This one seems huge to me. It kind of came under the radar. It didn't get a lot of press, but I think these types of usage of AI is really going to change the nature of a lot of technology implementations. And this is something we do a lot here at Ezra Group, is help advisory firms, wealth management firms, broker-dealers, RIAs convert from one platform to another. It's one of the most common projects that we do. But when it comes to financial planning, there's really no way to convert the data. When we're doing a CRM conversion, you move all the CRM data over. When we're doing a portfolio management conversion, you move all the portfolio management data over, all the performance reporting, you move all that over. But financial planning, there's nothing to move. There's never been any way to move data from eMoney to MoneyGuy Pro, from MoneyGuy Pro to Right Capital, or vice versa, until now. So Right Capital has announced an OCR technology to transition key plan data from eMoney into Right Capital. So the tech reads the financial plan in PDF format, identifies key client and planning data in the report, and automatically translate the data into Right Capital for advisors to review and add to the plan. It supports family information, financial goals, income, savings, expenses, property, insurance policies, and more. So, this is just going to be a major benefit to, well, I mean, every vendor is going to have this now, right? Capital is just the first. It's only a matter of time before eMoney and Money Guide, if they're smart, will build the same things, because you don't want to be, fighting with one hand tied behind your back. If right capital's out there pitching your clients and they can say we can move all of your data over, or at least all the important data over, no problem. You're going to want to be able to do the same thing to them. So, and this type of tech is not hard to build. We're seeing it in alternative investments, crunching all these PDF files that come in from all the thousands of alternative providers, and they're sucking those into the different systems. So why not do it in financial planning? So this is the first offering of its kind, minimizing manual work needed to transition financial plans over. And what we'd always had to tell our clients in the past was, if you're moving from one financial planning vendor to the next, you can't move the data. All you have to do is, when your clients come in the next time, either next quarterly or annual review, you update the plan one by one by one. So slowly over years, all of your clients migrate onto the new financial planning platform. But now, boom, you can get it all done much quicker. So I see this is going to be a bit of a game changer for financial planning applications. By the way, Right Capital has a WealthTech integration score of 6.6, which is number one in financial planning category. You can check that out at EzraGroup.com and learn more about Right Capital at rightcapital.com. And our next financial planning story. AssetMap announces new integration with eMoney Advisor. AssetMap has announced a new integration aiming to help financial advisors bring greater clarity to client discussions by combining eMoney's planning data with AssetMap's visual reporting tools. The integration allows advisors to import household financial planning data from eMoney directly into AssetMap, enabling streamlined conversations and the creation of client-ready reports. Advisors can leverage eMoney for in-depth financial planning and then use AssetMap's platform to present recommendations in a more accessible visual format. Completed AssetMap reports can also be delivered into the eMoney vault, offering a seamless experience for both advisors and clients. The move comes as tech adoption continues to shape client experience expectations in the wealth management space. According to Nitrogen's 2025 firm growth study, almost 70% of clients would consider switching to an advisor who makes better use of client-focused technology. The same study found that about 90% of investors would be more likely to trust their advisor's recommendations if they could see the data behind the advice. With new integration, advisors can import household members, entities, and financials from eMoney into AssetMap, pairing that information with visual storytelling to help foster trust and empower clients. The integration is expected to be available soon for joint clients of both platforms. AssetMap's latest partnership follows its recently announced integration with Holistiplan for tax planning and a strategic agreement with LPL Financial, which expanded advisor access to its visual planning tools. AssetMap is used by thousands of professionals globally and has mapped more than 2 million end investors and over $3 trillion in financial instruments. You can listen to the founder and CEO of AssetMap, Adam Holt, on our podcast, episode 314. Just came out last week. And you can look at their WealthTech integration score on our website, EzraGroup.com. Their score is a 7.29, which is excellent. And our third and final financial planning story. eMoney Advisor presents product roadmap and expert insights on the future of financial planning. At the recent 2025 eMoney Summit, CEO Susan McKenna kicked off their 25-year, or was celebrating their 25-year journey and their milestones, including 300 new data sources for the data aggregation, an addition of 25,000 new users, and a 96% client satisfaction score for customer service and support. They also announced a bunch of new features, which I was very interested in, since a number of our clients use eMoney, around their new client portal. They announced a premium version of the client portal, which is going to they claim to drive business growth. And they also have a mobile app and some new pages and personalized home pages. They have a Plan Explorer that they launched in July, which enables end clients to create multiple scenarios and explore how different decisions could shape the future. They have a new onboarding workflow that's super important. A number of our clients have had complained in the past about getting their clients onto eMoney and actually other financial planning tools as well. Onboarding is always a bit of an issue. So we're happy when there's new features and functionality around onboarding. And I believe that eMoney has announced the ability for the client portal for end investors to onboard themselves through the client portal or through the mobile app. Super helpful. Standalone data gathering, so they can, through the onboarding experience, they can gather more data, and new prospecting tools. Now, this is always interesting that there's so many different ways for advisors to prospect. Of course, is the lead gen, purchasing leads from these lead gen companies. There's marketing platforms, prospecting tools, and such. So, but there's also there are the digital marketing tools that are providing prospecting. But now these other applications like eMoney is offering prospecting. So a number of different ways for advisors and RIAs and broker dealers to access prospecting. So we had Susan McKenna, the CEO of eMoney, on the podcast, episode 306, a couple of weeks ago. And eMoney's WealthTech integration score is an excellent 6.11 in the financial planning category. And you can learn more about them at emoneyadvisor.com. Next up, wealth tech firm FNZ raises $650 million from existing shareholders. The international wealth management tech provider FNZ has announced a $650 million of fresh equity funding from its institutional shareholders. The capital injection has been earmarked to bolster FNZ's credit rating and enable the firm to deliver on its strategy to drive sustainable growth by investing in its tech, people, and products, according to a company statement. Now, while the statement lacked details on how much its investors are contributing, the firms involved in the round include La Caisse, Generation Investment Management, Canada's Pension Plan Investment Board, and Motive Partners, as well as some of FNZ's clients, including Aberdeen Group, Aviva PLC, First Cape, 91, and Nucleus Financial Platforms. What's crazy about this is the company just raised $500 million in April of this year, which at the time, that funding was to provide financial strength to support FNZ's long-term business plan. So now they got a lot more strength. And that raise was just 3 years after they raised $1.4 billion in 2022 from CPP Investments and Motive Partners, which valued the company at over $20 billion. That's just tremendous. Last year, FNZ named former JP Morgan exec Blythe Masters as its new group CEO, succeeding founder Adrian Durham. Now, part owner of FNZ is Motive Partners, and they have significant stakes or has owned several U.S. financial services brands, including Fiserv, which they lifted out the APL division a couple of years ago, and then they merged into InvestCloud. They own BetaNext and Mediant Communications. FNZ is playing a big hand in North America with some key client implementations, having been more involved than anticipated in tying up a lot of resources, wrote Alois Perker, founder of Perker Partners, in an email. All in all, it looks like a defensive move. Perker noted FNZ's strategic partnership with the Canadian arm of Raymond James in June also seems defensive to Perker. So now the FNZ has a number of other announcements this year. Back in August, they announced a major 5-year innovative partnership with Microsoft to collaborate on AI-driven solutions. That should be interesting. And back in 2020, FNZ acquired a majority stake in State Street's Trust Custody Unit. And then they rebranded that unit FNZ Trust Services with a minority ownership still held by State Street. A lot of people expected that to make some waves in the US for FNZ, but nothing really happened from that. It sort of has been on hold. Although there was another announcement in 2022 that their first client or their first partner in the US for custody would be Envestnet. And CEO at the time, Bill Krager, announced that they were getting into the custody business. But as we all said, we all have not seen, nothing happen with that. So it really sort of died on the vine. I think firms realize it's a lot more difficult to get a custody service running in the US than it seems, and things sort of just didn't get going. So that didn't happen. But still, FNZ has $2 trillion in combined assets under management and assets under advisement on its platform, with more than 650 financial institutions across 12,000 wealth managers worldwide. You can learn more information about them at FNZ, or for those of you in the US, fnz.com. We're up to my favorite part of the news, the WealthTech Integration Score and the AdvisorTech Map. Now, this month, we've shifted the recording of the news a little earlier in the month. So I haven't had my meeting with Michael Kitces yet for the November or the December map, which is what I would be talking about in the November news. So we'll save the December map updates for the December news, which will come out in a few weeks. And we're talking about the WealthTech Integration Score. We've got a good number of products you can check out at ezragroup.com about now we of course mirror the Kitces map, Ezra Group map, on our website, showing the Ezra Group WealthTech Integration Scores. About 80 of the products, about 15% of all the products on the Kitces Ezra Group map have a score of 6 or higher, which we consider excellent. So that's we're trying to keep that. We're obviously trying to grow that, but we're trying to be very strict and conservative about our scoring. You can check out the methodology on our website, so it's open to anyone. You cannot pay to get a better score, but you can ask us how we can help you improve your integrations, build out more robust and deep integrations to improve your score. And about 40% of our products have a score between 1 and 6. So they're working the way up. We're greatly encouraging all products and all vendors to increase their integrations, increase the transparency of integrations by providing the data into our website at ezragroup.com. If you are a product vendor, you can register at ezragroup.com/register your product and then update your own integration data. Our crack integration team will review your updates and approve them, and your integration score will update automatically. So you can check that at any time. The median score has been slowly going up over the past couple of years since we built out this platform. It's up to a 4.56 at the moment is the median integration score across all applications. Again, more information at ezragroup.com. And that's it. You've reached the end of another episode of the WealthTech Today podcast. Thanks for listening. But before you go, head to our website, ezragroup.com. I say that over and over again. Go to our website, go to our website. I hope you're going. But go there to the homepage, scroll to the bottom, and sign up for our newsletter. Once a month, you receive an email chock full of wealth management goodness, news, information, and updates. You will not be disappointed. Thanks again for listening, and talk to you all again next time.